Vikas Khemani, good morning. Thank you for joining us. On budget day, when I spoke to not one, 10 people, 10 on 10 told me this market is not headed anywhere. Look at what is there.
It's true. Everyone was so quick to write down the budget.
Some had finger on their lips.
Yeah.
Some were absolutely quiet. Some were shaking their head like this.
And some were lambasting it.
So you didn't speak to me that day, though. I think, obviously there was a reaction to the budget in a particular way. But at least as I wrote in my article post-budget that we are neither excited nor disappointed. We were kind of neutral. And we have seen, budget over last many years. It is generally 1 or 2 or 1 week probably max kind of phenomena. Post that, markets get back to normalcy of the day-to-day economic development and all the realities of earnings growth and what's happening on the ground. So and that's what again has happened. So the good part is that the liquidity flow remains fairly strong into equities, and in short term it is demand and supply which drives. So which is what has happened. We continue to remain positive from the markets from medium term to long term perspective. Of course, one should not overlook the risk which comes from outbreak of coronavirus in China. It can still have a lot of markets right now are overlooking that in expectation of sort of stimulus or revival from the governments. But I guess the real impact of that would still be sort of felt maybe in my opinion a couple of quarters, because every global economy is integrated with China in one or other way. Yeah.
Okay.
What are the lessons to be learned from D-Mart? I had enough and more people, and I also thought, I must confess, that if you buy retail stock at a P multiple of 70, 80 times, you will not make money, because ultimately, grocery retailing is a thin or a wafer thin margin business. Yet, post the listing, which happened at 600 rupees plus, the stock today is sitting at 2400. For those who called it expensive, have they missed on a multi-bagger in making in last 3 years?
Absolutely. It's only, I think, in my opinion, only one lesson to be learned. If you have a business which is run by an outstanding manager or a promoter, good business which has a structural legs to growth, and lastly, it has a low floating stock. If you see these three combinations, don't worry about the valuation in shorter term, because and we have seen it's not only one, not only D-Mart, many more, including Bajaj Finance and many more.
Bajaj Finance promoter ownership is actually very low.
No, it's not low given that business. If you see, it's not low given that business, because there the raw material is money, right?
Deepak Parekh does not own even 1% of HDFC. And look at
but he's an outstanding manager.
Yeah,
right?
and what I'm saying is that yes. Piramal promoters own more than 50% stake. Look at what's happened.
Right. So, I personally believe that, let's say if there was a 60% floating stock in D-Mart, these valuations won't trade. So it plays a role, because I think it's a company which everybody wants to have in their portfolio, and ultimately it's a demand supply, right? If you have less supply, you will tend to overvalue it. So that's how I see it. So this is a typical. So the lesson to learn is that stay invested as long as you see a great manager and long legs to growth. And D-Mart can be a 20-year story. We have seen how Walmart played out in US over 20, 25, 30 years. And I'm sure, I don't know the early valuations of the early stage of that story. But, if you look at that kind of value creation, probably D-Mart could also be very well in that league. I don't know that. But at least there's all signs that from a management perspective, from the potential of the opportunity perspective, they're rightly placed.
Are we missing other stories, Vikas, in the rush that the market has towards these handful of stocks? I mean, clearly, while we're hearing there are green shoots, that there's opportunity, there's reluctance to really go beyond that.
So I think, we've seen in last 3-6 months, it has got better than what it was probably, 6 months ago. There is a little bit more wider participation which has happened in the stocks which markets were not touching 6 months ago. So this is all function of risk appetite coming back, function of how money flow is coming to the market. Of course, still the all-out confidence in the economic revival is still not there, and I feel it's a function of more and more confidence getting built as the data comes through. You will see wider participation happening, and I think SEBI also, if they allow, one of the big reasons why midcaps took a beating was SEBI's rule for mutual funds restricting them in a particular basket. So I think if they ease out on that, probably that can also lead to some sort of wider participation.
Is the year going to belong to even the consumption-related, pickup? Do you think that basis expectations that we will see that rural economy, seeing some sort of an uptick, that consumption would be a sector that you would look at? Today, we were just comparing the kind of dichotomy that we're seeing between HUL, all-time highs, vis-a-vis ITC.
So I think, look, again, I can't really say what will the year belong to, but I do believe that, lots of wider participation of the sectors would happen. Of course, BFSI, credit and non-credit has been doing well, will continue to do well. Consumption also, as long as there's a growth, I think ITC does not do well on that count, but I think as long as there's a growth, stocks do well. But I do believe some of the sectors, which historically have been kind of not likes of pharmaceutical, or maybe to some extent we see even commodities coming back with some sort of manufacturing coming back in later part of the year. So my hypothesis is that if the credit growth picks up from here, you will see a reasonably wider participation, and the green shoots of credit uptick is happening, but it's nowhere close to where it should be.
Sure.
So the only indicator which we which we watch is how the credit growth is going to be, because that is one of the biggest problem of our economy right now. There is ample liquidity, so ample liquidity is one of the precondition of growth.
Sure.
So that is there, but it has to still trickle down to the users of the capital. RBI is trying, government is trying, but we have to still see that happening. And once that happens, I think a lot of concerns will start receding.
Everybody in the market, Vikas, now has reconciled to this 80-20 rule, which is that 80% of the earnings will belong to 20% of the companies. And there is evidence of it in the aviation sector, in the auto sector, in the construction sector, even in media sector. If that 80-20 rule is going to be the universal accepted theorem or theory, how does one go about investing in those 20% of the stocks? Because that's where all the excitement, joy, momentum, and concentration is.
I would say that one of the key fundamental principle of investing, especially and India is going through a phase of unorganized to organized, so it's always pays off to remain invested into category leader. Number one, number two player. If you remain invested, you will usually do well. So the call you have to take is which category you are or sector you are bullish on, and go and invest into number one, number two player in that. You will come out very reasonably okay. And which is what I think also supports the hypothesis you say. So you don't have to, for the sake of being adventurous, you don't have to go to the, names which has no advantage. So you might as well, go to the companies which has moat, which has, which commands large or controls large part of the profit pool of those categories or sectors. And that's the way to make money in the market.
I had an economist in the morning who said that economy is not going to turn. That's a personal view. I have a fund manager on the show today who believes that things are looking up. One of you will get it right, one of you will get it wrong. Will markets prove the economists wrong, or will markets prove the fund managers wrong? So far, fund managers have been proven wrong.
See, it's all context. At some point in time, everybody's right and everybody's wrong.
3 years, 3 years,
so
3 years.
In 3
Last
years,
3 years, fund managers, I'm not getting into names here, I'm just saying the whole template with markets worked with, which is that earnings will come back. That's not worked.
Yes.
Economists came out with the template that economy will slow down. It has worked. Markets are saying fund managers will get it right. Economy is saying that economists are getting it right.
So I think if you spoke to anybody in 2018, I don't think anybody gave any sort of probability to an ILFS kind of crisis. And we cannot ignore that. I mean, ILFS, in my opinion, was our mini Lehman moment. And whatever we are seeing in last 1.5 years or post that, I think was aftermath of that. And of course, if for the US kind of economy, government's response would have been very different, the recovery could have been fast. But unfortunately, in our setup, that's not happening. Hence, we had a prolonged slowdown and the impact on the economy. We are seeing now a lot of concentrated effort being made to revive economy. Now, risk appetite goes away very fast, but comes very slowly. So when you make efforts to correct something, especially when revive risk appetite, I think it will take time. And still, I feel that a lot more coordinated moves needs to happen rather than, sort of piecemeal, and which is still missing. So that makes me believe that it will be more prolonged and slow recovery rather than a V-shaped recovery. But I would assign more than 90% probability of economy doing well in 3 years' time. If you ask me in next 6 months, I can't, but at least I would assign a very high probability for a 3-year recovery path.
The Prime Minister, speaking at the Times Now Summit yesterday, is talking about that. He's talked about how it's challenging, but they're working overtime, that this is India's decade. he's referring to growth in tier 2, tier 3 cities, and he's also talked about reducing the tax, not terrorism, but the overhang really of bureaucracy and so on and so forth. Do you agree with that vision, Vikas? Do you feel the government has done everything possible to ease doing business, ease everyone's liquidity as well?
It's a long, I mean, I give a very long answer to this question, but the short answer I can give is that I have no doubt about the intent of Prime Minister and the government. I have a lot of issues with how it's being executed, how it's being, executed in a coordinated manner. It's like this last budget we announced, providing liquidity to NBFCs, and it took them 6 months to implement the first, or more than 6 months.
Because now, this government only has a certain amount of time left. So if we're talking about 3 years,
so it's not about time. I think you can do these things in, when if you look at, again, compare with the Lehman crisis, how, a coordinated effort was made to revive the economy in a short period of time. So here, what intention, I don't think we can question at all. I mean, I'm a big fan of Prime Minister as a Modi as a leader. But I think that there needs to be a lot more, coordination, a lot more thought through efforts in implementing and getting it down to sort of, in my opinion, letting Jet Airways underground was one of the biggest disaster India could have. And who's paying? Consumers are paying, and also banks are paying. Now somebody had to take an approach to let it remain alive, and that could probably happen to Vodafone as well. Now these are the big blocks. These are the things which create huge amount of issues in the economy. But somehow it appears that government has taken hands-off approach on that. Whereas right now you need to have hands-on approach if you want to revive the economy. And that is, to my mind, today credit growth is not reviving. Now credit growth revival is one of the urgent need of the economy. Without credit, no matter whatever numbers we talk, it won't happen.
And you're right, I think this is an endless debate because they will continue to say they're doing all that they can, and people are not following suit on some of those measures.
So the combination which you work with, Vikas, is buy a good business where there is a change of management. Every year, 10-15 promoters, when I say promoters, the CEOs, they change. Where do you see that combination of right now markets are nervous, underlying business is going through a cyclical slowdown, and there's a change of top which could reignite the business?
Many, I think, businesses, and as you rightly said, time and again you keep seeing that, and they're good businesses. One of the businesses, we have liked and we've discussed about is ICICI Bank. Post change of CEO, change of management, I think there's a huge amount of, change in the bank, how it functions, it's operating profitability, it's the entire approach, it's customer satisfaction if you do overall. So we believe that, a good management, good CEO can make a very big difference to given the same business. Banking has been always a great business. one bank does in a particular way, other does in a particular way, and the key determining factor is management, it's strategy. So I think something like that, and many more are there.
So IndusInd Bank and HDFC Bank will soon see a change of guard. What Aditya Puri has built, I think it's a franchise which is built to last. What IndusInd Bank has done, I was looking at the data in last 10-15 years, it's done much better than HDFC Bank. So if there's a change of guard, and I hope their successors are, able to implement the brand forward or take the brand forward. But from a market standpoint, do you think these two stocks now run the risk of market performing or underperforming?
Well, it can be. Look, it's very difficult to fill shoes of a leader like Aditya Puri. It's a legend. He's a legendary leader, right? So anybody who comes in will come with a very high expectation, and he'll have a tall ask. So to that extent, in my opinion, there could be some disappointment. I think the market hypothesis right now is that if Mr. Puri goes and whosoever comes, at a base where it operates, it will take a couple of years of adjustment, readjustment, conditioning for it to kind of continue the same kind of growth. And also, mind you, HDFC Bank operated in last 10-15 years where the competition was weak. Now, other competition is also kind of picking up, so. But I have no doubt that these organizations will last for long. They will continue to grow. Can this disappoint in a shorter term? Answer is very much yes. We need to see how, who comes, what kind of, vision is being charted out. So today this is a hypothetical situation, but is this a market worry? Answer is yes.
Vikas, many thanks for dropping by and giving us your take on the markets as well as individual sectors and, strong companies, how to identify them. Good chatting with you.
Thank you for having me.